Hi class, this video is the third in a series of how we record depreciation, and this video is going to focus on reducing balance depreciation, which is all on chapter 16 of your Macmillan textbook, pages 309 to 317. Remember, this is the third in a series of videos. There will be a fourth one as well, so I would recommend that you've watched the first two because there will be some assumed knowledge in this video. What are we going to focus on in this video? I hope by the end of this, you should be able to describe, calculate, record, and apply reducing balance depreciation. So we'll achieve the learning intention, but just for reducing balance depreciation. And particularly, we should be able to record all of this in our general journal, general ledger, and accounting reports. There is some assumed knowledge of the recording in general journals and ledgers, which was described in detail in the video on straight line depreciation. So what is reducing balance depreciation? Reducing balance depreciation is a method used for assets that are expected to be more effective in terms of generating revenue in their earlier years of use rather than in their later years. So what do I mean by that? The assets that apply reducing balance depreciation are going to be better at generating revenue, be more efficient in their earlier years in life than in their later years of life. What type of assets are this? Simple, often the question will tell you, but if you're being asked a question, often these are ones that have a lot of moving parts, lots of technology in them. The more technology, the more efficient they are at the start. But as this technology gets older, it becomes less efficient to ultimately it becomes obsolete. So these assets are like vehicles, machinery, equipment, things that has lots of moving parts. These assets, because of this increased efficiency at the start and reduced efficiency at the end, do not have a consistent revenue earning pattern over their life. And an example might be a vehicle, as we talked about. These are considered for reducing balance depreciation because vehicles are very efficient when new, but they are expected to spend more time off the road when older. Therefore, their revenue earning capacity declines as they get older. This is different to assets like office furniture in the previous video, which usually has the same revenue earning ability. Again, most questions would tell you which method to be used, but if you're asked a question about which is the most appropriate or when should you apply reducing balance and straight line, these are things to be considering. How constant or consistent is the revenue earning pattern of this asset? So how do we calculate reducing balance depreciation? The reducing balance method uses a fixed percentage, and it multiplies this by the asset's carrying value. What do I mean by carrying value? The amount that the asset is worth at that time. Remember, it is the purchase price or the cost minus the accumulated depreciation. So as we get more accumulated depreciation, the carrying value or the value of our asset that we are carrying reduces. So the formula to do this, unlike in general maths, as you know, is complex. The good news, unlike general maths, is you are going to never be required to calculate it. You will always be given the percentage and then you are asked to apply it. This is not a maths unit, this is an accounting unit. So let's look at an example of how we would do this. As an example, on the 1st of July 2022, this business purchased a vehicle for $40,000 plus GST. We have the cost of this asset, $40,000, because remember, we never include the GST. We know that the depreciation method is reducing balance and the percentage is 25% per annum. And the reporting period ends on 30th of June each year, which means, thankfully in this example, we bought it at the very start of the reporting period, so all our calculations are going to be done by year. This will be a complication if it is not 1st of July, and we talked about this in our previous video on straight line method. So the depreciation for the first year is $40,000 times 25%. 25% of the asset's value is reduced at this Yeah, because the carrying value in year one is the actual purchase price because there has been no accumulated depreciation calculated already. So $10,000 depreciation for the first year. How do we record this? We record this in our general journal. Depreciation of vehicle, the expense is a debit because as we always know and we keep reiterating, expenses increasing our debits. And we also have a credit, accumulated depreciation of vehicle, because we are recording that our asset is going down. This is a credit, and accumulated depreciation of vehicle is a negative asset account. It's where we store and record reductions in assets. We've got our standard template for a narration, adjusting entry for depreciation, reducing balance, and there would normally be a source document, some type of memo to record. We would then pick this information up and record it in our ledgers for depreciation of vehicle, our debit, so left-hand side, showing the cross-reference of accumulated depreciation of vehicle because that is our credit, and accumulated depreciation of vehicle, we will record a credit with the cross-reference as our debit being depreciation of office furniture. We know, because we've already watched the video done straight line method recording, that depreciation of vehicle is an expense account. Expenses get closed at the end of each period to determine profit and to make it go back to zero so we can start the process of recording expenses again. We would ultimately also balance the accumulated depreciation of vehicle if we had space on this slide because we balance assets, liabilities known as equity. The difference here is in the second year. In the second period, this is where the differences in reducing balance become apparent. Straight line method, the expense of depreciation is the same each period. It is not the case in reducing balance. The percentage rate per annum, 25%, is still used, but we now apply it to the new carrying value. In year one, we applied $10,000. However, we have a new carrying value. The new carrying value is now $30,000 because carrying value is purchase price, cost price, minus accumulated depreciation, and we have $10,000 there. New carrying value is $30,000, and we apply the 25% to that, which means we now have depreciation of year two of $7,500, hence the term reducing balance depreciation, because the depreciation expense reduces each period. We now have accumulated depreciation of $17,500, and our year two general journal entry, which I don't have in this presentation, would be depreciation expense, $7,500 as our debit, and accumulated depreciation as our credit of $7,500. So to summarize depreciation over periods, we will keep applying this 25% over the 4 years to the carrying value. And you will need to be required to actually start to become good at making tables like this. For really 3 columns, depreciation expense, accumulated depreciation, and carrying value. We always need to work out the carrying value. So after year 2, if you look at the second row, we have a carrying value of $22,500. 40,000 minus 17,500. We then apply, if you look down at year 3, a depreciation, find out our depreciation expense of calculating 25% of that new carrying value, which equals $5,625, which means our accumulated depreciation goes from 17,500 to 23,125 because we're adding 5,625 to it, which means we have a new carrying value of now $16,875, which becomes our new basis to work out our expense for year 4 and so on and so on. So this is why you can see on our second column, depreciation expense, this number keeps reducing in value each year because there is a lower carrying value each time. This is what you're going to need to be calculating. You're not ever going to be required to calculate using the fancy formula we're used to in general maths. And that's appropriate because we don't have fancy calculators in year 12 accounting. So what do we need to know? just remember, you don't need to. You can round these off to the nearest dollar as we get into year fours and stuff, and it's likely that you might see some decimals here. That's okay, because in terms of the relevance characteristic, or we do only need to show this information that is relevant for decision making. Clearly, decimals and cents aren't relevant for a $40,000 vehicle. So that is how you summarize reducing balance depreciation. By combining your knowledge of what you've watched in previous videos, hopefully this has allowed you to achieve the learning intentions that you now leave confident that you can describe, calculate, record, and apply reducing balance depreciation. Keep practicing your accounting depreciation questions.